Now, a little earlier in the hour, we did focus on the tribulations of emerging markets and developing economies where there is a scarcity of US dollars, the very lifeblood, if you will, of global trade. And that scarcity is obstructing business and it's piling pressure on local currencies. In fact, for many frontier economies, they're struggling to actually cover their import bills, and that's being exacerbated by the tightening of global financial market conditions. Let's explore this in a bit more detail with Kwame Owino. He's the CEO of the Institute of Economic Affairs here in Kenya. So Kwame, lots of talk last week about the need to reform debt treatment at the global summit in Paris. But from your perspective, did we really get any meaningful outcomes from that event that can make the G20 common framework work better?
Good evening, Rama. No, I don't think we did. Well, let me just say that the only thing that came out was the urgency to do something, because many countries are actually struggling, and sooner than later, it's better to have some plan rather than actually have to confront a number of countries altogether facing a crisis that could actually aggravate everything. But I don't think that anything meaningful happened which would change any country's posture about how indebtedness suddenly, and obviously the overhang could be handled based on the statements that were made. There's quite some rhetoric around it, and these are difficult issues, so obviously we must cut them some slack. But on the whole, I don't see anything changing except for the fact that, yes, there's more urgency now than there's been before.
Indeed, and the US dollar also comes in for a fair bit of criticism. In fact, you could say perhaps now it's the core thing to do, to bash the US dollar. But the fact is it's widely accepted across different markets. But if African countries want to borrow amongst themselves, if Nigerian companies want to borrow in rand, if Kenyan companies want to borrow in naira or the Egyptian pound, what do they need to do to clean up both their monetary and their fiscal policies?
Well, I don't think that they would. Let me just say that they'd be taking great risks. Not only taking the risk of the investment itself, but taking the risks that you're going to rely on these central banks to actually manage monetary policy internally and in a way that actually continues to keep the value of your money. So managing inflation is something many central banks on the continent are actually struggling with. The reason the US dollar is it's an open economy. It has very strong companies that operate both within and outside the US itself. So basically, borrowing in a domestic currency is actually taking a bet on the monetary policy of those countries. And in some cases, monetary policy is dominated by there's fiscal dominance. And that's a really, really risky thing for a business person who does not have direct influence to take. So in my view, unless the competence of monetary authorities rises in this African continent, I think few companies would actually take those risks unless they were themselves situated in those countries.
Indeed. Just for the sake of our viewers, fiscal dominance is a term that we often use in our line of work. But could you give us a layman explanation of what we mean when we talk about fiscal dominance?
All right. So, conventionally, the Treasury and the executive arms of government are given the authority to actually determine how spending takes place. On the other side, the monetary policy authorities, which is the central bank, generally takes decisions to stabilize prices and a few other things, usually to stabilize prices by preventing inflation. Now, in many countries, such as the one in which we are now, Kenya, there is suspicion, I think very, very true, that right now monetary policy is entirely being run to make it easy for government to borrow money, as opposed to stabilizing prices generally. And I think that has an effect, because it means necessarily that if for instance, the currency, if there's a need for a currency to actually float, central banks sometimes use more money than is necessary to support currency at a given or preferred level by the political authorities or by the Treasury itself. So that's fiscal dominance, in the sense that monetary policy is being run, and the question of maintaining stable prices is secondary to what government's borrowing requirement or ability to pay becomes.
Right. One last question for you, Kwame. From your perspective, and I'm going back to something you mentioned a little earlier in the conversation, what are the merits and the demerits of the argument that some countries essentially need to deal with their debt problems head on? Because if you look at some of the metrics you use to look at public debt service capacity, debt service to revenues, for example, in some cases, like where we are now in Kenya, it's well north of 50%. Debt service as a percentage of export revenue, it's verging on 30% on average across sub-Saharan Africa. On paper, it seems like there's an argument to be made here for countries to go to their creditors and say, look, we need a bit of breathing room here. But it seems like there's a bit of stigma among policymakers, or denial perhaps, that's telling them, we're not actually going to do this.
Yes, I think it's basic, and you've seen a couple of African countries. I mean, credit to them, they've folded in now. I mean, Ghana, Zambia, and all that, all past those stages where in the early stages it was very, very clear that a need to actually bring in creditors together and deliver a plan to them before the bottom fell off could have been done. But the logic of it on the economic side is very real and very clear. It is politically difficult to serve because it exposes a government to political pressure for incompetence generally, and of course having to own the fallout that inevitably occurs. So I think that there are certain countries in here on the African continent and other parts of the world as well who need to start it early. But starting it early, just like in Sri Lanka's case, in Ghana's case, obviously in Zambia's case, is usually difficult because it's an admission of mismanagement or incompetent management of the economy. So that's what. So the political risks and the costs is what is usually difficult for people to bear.